Right, morning everybody. I'm just trying to get some video on here. Doesn't seem to have any video at the moment. Bear with me a second. Get started. Right, shall we get going? Good morning everybody. Today's topic is tax hot topics, as the screen suggests, and you've got me. I think it's Christmas jumper day, so I'm supposed to be wearing a Christmas jumper today, but I've forgotten to put that on. So you've got me in normal attire today. So we'll just set the scene for today a little bit. Bear with me a second because my slides don't seem to be moving forwards. Sorry, good technical start here. Bear with me a sec. I think we have this problem when Sarah's as panelist. Sarah, I don't know if you want to just dip off as a panelist a minute so I can just take back control of the slides. The slides aren't moving again, so we're going to need to dip out. Right, sorry everybody, back in business now. Okay, so what will today's webinar cover? So just to say to start with really that this is not intended to be an in-depth technical session. It is high-level awareness of current topical issues and things that we are at ETC seeing regularly at the moment. So there will be some assumed knowledge, not lots, but some of the terminology. And really the takeaway for you today is to be able to talk to your clients about topical tax issues and things they need to watch out for. So we're not going to be going to in-depth technical analysis here. It's just really to highlight some of the things that we are seeing regularly at the moment. So let's kick off. Can't get used to this slide control. There we go. So the first thing that we're seeing regularly at the moment is clients with surplus cash, which, as I've said, there is a nice problem to have. So although we've just come out of the pandemic, or relatively recently, we're still talking about the pandemic, and lots of people we know from the headlines and from the news are struggling, and that's definitely the case for a lot of people. We have got a number of clients who have, managed to build up surplus cash within their trading company and or investments. I'll put there. I'll come back to that in a minute. But so clients who have trading businesses, one of the ones that we've just looked at recently was in relation to a client who runs her own law firm, and she has built up some surplus cash in her trading company. And clients really often want to use that cash for future generations, for children usually. They don't have any need for that cash themselves. They're already taking dividends and salary from the business. And so the pot of cash that they've built up, very fortunately, they want to do something with that a bit more exciting than just having it sitting in their trading company. Some of those people are also concerned about inheritance tax, not all. We have quite a number of younger clients who are in their early 30s who, whilst it's never too early to think about inheritance tax, just have had a lot of success with their business and are wanting to, use that cash, surplus cash for future generations. But inheritance tax can also play a part here. So I've put on the bottom here, consider use of a family investment company. So FIC, family investment company, is something that I'm sure you've all heard of. It's been a buzzword now for a few years, and I'm just going to mention now what a FIC is, because I want to dispel some myths here. So the first thing I would say, what is a family investment company, is it isn't some kind of mythical beast or creature or something kind of out of the ordinary. It isn't anything unusual, actually. And I think we, in the tax industry and in the press and just generally in the market, there's lots of talk of FICs. And people get quite excited about FICs, and rightly so, but actually there is nothing mysterious about them. So a FIC is simply a UK resident private limited company, the shareholders in which are family members. We'll talk about that a little bit more in a minute in terms of who might hold those shares. So the company exists to make or hold investments, obviously as distinct from the trading business, which we talked about earlier. Those investments might comprise cash, loans, residential commercial properties, share portfolios. I mean, there's no real limit on what those investments can be. It depends on the individual's appetite for risk and where they want to place their funds ultimately. And at that point, we'll be looking to use an investment advisor, wealth planner, to perhaps assist them with their investment strategy. It's not something we get involved at ETC. So those investments then are then held often in order to generate an income or potentially capital growth, or a combination of two, again, usually, as I say, for future generations, as opposed to the individuals who hold the trading companies themselves. So a number of things to consider when we're thinking about family investment companies. The first thing to consider is I suppose, how we structure that arrangement. So if you think about a situation whereby an individual has their trading company and that's all they have at the moment, they don't have any other companies, there's no holding company in place, for example, the first thing to consider when thinking about an investment company, a family investment company, is whether that should be a holding company of the trading group, a subsidiary of the trading group, or an entirely standalone company. And there are a number of important tax considerations to consider there, as well as practical and commercial considerations. So again, as I say, this isn't meant to be an in-depth technical session, but just to mention some of those things that we would want to consider when we're thinking about how to structure that potentially small group. So we'd be thinking about things like business asset disposal relief. So as you will be aware, I'm sure, if you have a trading business and certain conditions are satisfied, you can avail yourself of business asset disposal relief. Where you start to have investment assets or investments or even cash muddying the waters, you can taint your business asset disposal relief position. And that can also apply when you've got a small group structure. So business asset disposal relief applies where you've got a trading company or a holding company of a trading group. So we've just got to be careful that when we're setting up this structure, we aren't causing a problem for business asset disposal relief. The same applies for business relief, which is inheritance tax relief. And again, similar to business asset disposal relief in the sense of ensuring that you keep those trading and investment activities separate. The other things to think about when you're thinking about the structure are some of the practical things like the associated companies rules, which some of you will be familiar with, I'm sure, in terms of what it means if you've got multiple companies run by the same individuals in terms of your tax bands and the way that tax is applied across those companies in terms of whether they are associated or not. And there are obviously some practical and commercial considerations as well. Clearly, if you are thinking about putting a holding company in place, there may need to be some form of share-for-share exchange, which we are obviously used to doing here at ETC. I'm sure, again, many of you have come across those before, but that would involve exchanging shares in the trading company, potentially for shares in the holding company. So the individual exchanging their shares in the trading company for shares in the holding company by way of a share-for-share exchange, and often a clearance is required from HMRC for that. Other things to consider, therefore, so we've talked about the fact that these vehicles are often used to provide income or capital growth for future generations. So often, not always, but often, the individuals themselves, those that have operated their trading businesses, don't need more income. That's the point, really. They've got what they need from their trading company by way of dividends and salary, and what they're looking to do, as I say, is to invest for future generations. So the way you would want to structure that is to have potentially different classes of share in your family investment company, which have different rights. And again, this is more of a legal point, really, but obviously there are tax considerations. So thinking about whether we create alphabet shares, A's, B's, etc., such that some of those shares have rights to income, others don't. Some have voting rights, others don't. So let's call them the parents, those that run the trading business, can still maintain control of the company, but don't necessarily require income, so they can then determine that the B shares, let's say, have the income rights, whereas the A shares that perhaps they own, which have perhaps the voting rights, don't have any requirement, don't have any entitlement to income. Another thing to think about is how and when to move the cash and assets to the family investment company. Now, we have clients who perhaps have already gone some way down the road towards establishing a family investment company. So let's say that we have a client who has a number of buy-to-let properties already within an investment business, or they have a company where they've already bought some shares. Now, obviously, that company will already have some inherent value, whereas if we are looking, as we often are, at clients who are establishing family investment companies from scratch, at the point at which that structure is set up, there will be no value in that structure on day one. So thinking about how we move the assets across first and foremost, well, let's go back to when, because that's where I was going with that. So the when refers to valuation, really. So if that vehicle already has some value at the point at which these new share classes are created, then there can be capital gains tax and inheritance tax consequences as a result of not so much creating those shares, but giving those shares to family members. So that's just something to bear in mind. And again, just making sure that you are talking to clients about capital gains tax and inheritance tax, or getting advice on that if there is already value associated with those shares. The how then, so lots of clients say, well, how do I get my cash from my trading company to my investment company? And the answer to that will depend on how we have structured that in the first place. Clearly, if there is a group in place, there are opportunities for dividends to be paid up potentially, especially if you have the FIC as the holding company, for dividends to be paid up from the trading company to the holding company, which is obviously a very neat way to do things. Equally, if there are assets currently held by the trading company, let's say the trading company has some buy-to-let properties that are unrelated to its trading business, those assets could be divvied up by way of a dividend in specie to the family investment company potentially. Again, obviously there are tax considerations, but we need to think about those, and we can help with that. If, on the other hand, you've got a standalone family investment company, the most obvious way to get the money across the family investment company is to loan that money into the family investment company. Now, if that money has been taken out of a trading company, essentially, by way of salary or dividend already, then clearly tax will have been paid on that amount. So that's not a particularly tax efficient way to do it. Nevertheless, on the loan into the family investment company, that can be treated as a director's loan. And so, of course, then when the individuals are taking money back out of the company, they can do that tax-free. There are also the possibility to make the intercompany loan as well. But again, we've just got to tread carefully with intercompany loans, absolutely fine, but we've just got to make sure that the tax and the accounting treatment are dealt with correctly on intercompany loans. The other options really are to transfer cash to a no rate band, up to the no rate band, into trust, and then to subscribe for non-dividend shares in the family investment company. We talk about non-dividend shares because the dividend tax rate is, of course, 39.35%. I always have to check the rates if I'm glancing down. And so you don't want to be in a situation where a trust is holding shares that are entitled to dividends, because taking dividends out for a trust is very tax inefficient. So again, so there's options there really, and again, depending on the assets that we have perhaps already got, which the client already has, then obviously we need to think about the way in which those assets and or cash move into the FIC. So for example, if property is held already, then we need to think about capital gains tax, stamp duty, land tax consequences of the potential move of those assets into the family investment company. We've talked about valuation a little bit already in the context of when we move those cash and assets into the FIC, but also thinking about different classes of shares with different rights and the valuation therefore placed on those different classes of shares. So, as we've said, it will depend on obviously the inherent value in the family investment company at the point at which those shares are created and or gifted to individuals. But ultimately, if there are minority shareholders, for example, the valuation may be lower on those shareholdings. If they have no rights to dividends, then clearly there'll be a potentially lower value on those shares. So there are lots of things to consider in valuation terms. We can assist with valuations. Accountants often get involved with valuations. And yeah, overall, it's just making sure that what we're doing is robust. There are also obviously a number of legal considerations, and you will necessarily, or client necessarily will need a lawyer to get involved to create those different share classes, to amend articles of association and things. So that's where we go with the family investment companies. So we've seen quite a few recently. We have one that we're working on at the moment with a young man in his sort of late 30s who has run his own sort of outsourced finance director business and has had a lot of success with that over the last 3 to 4 years. Has built up about £800,000 in surplus cash in the trading company, expects to build up another 180,000 each year for the foreseeable future, and so really wants to invest that for the benefit of his children, who I think are about 5 and 7 years old. So we are giving some advice on that at the moment for him. Right, moving on. Second issue we're seeing quite regularly is that we know that the employment market has been tricky. I mean, I think the talk is of that starting to loosen up a little, although clearly that's not always a good thing, as that might be due to redundancies and things. However, we know from talking to a lot of our clients that one of the main difficulties they're having at the moment is in finding and retaining staff. Now, combine that with the fact that cash flow is often tight at the moment. So lots of small businesses, need those people. Obviously, they want to grow, but their cash flow is tricky. So an obvious way to think about incentivizing people outside of your usual, increased pay and bonus type arrangements is to think about share incentives. And that's where a lot of our clients are talking to us at the moment about what they can do to incentivize their staff, either to find them in the first place or to retain them once they're already there. So for most small businesses, the main options there will be EMI or gross shares. I've just put a bit of a reminder here. I'm not going to go through this slide in detail, but just again, I said this wasn't an overly technical session, but just helpful to remind you of a number of things around EMI schemes. So it makes me chuckle really because EMI schemes are, I've said, helpful for small business, and small business in the context of EMI is defined as less than 250 employees and less than 30 million of gross assets. So quite a substantial small business. There has to be a trading company. So we'll talk about that in a minute, actually. Although I haven't put case studies into the slides, I will talk about, again, an example of one we've just done with a client who runs a training business, and what we had to do with that in order to allow him to qualify for EMI. The scheme is discretionary, so you can choose who participates. One of the barriers, and again, I'll talk about that in the context of this particular client, is that there is no more than £250,000 per person available in the form of EMI options or shares, and 3 million in total across the scheme. Which again, 3 million total across the scheme, quite generous. But if you've got a particularly high earner, 250,000, it's easy to see how that could be reached quite quickly. The other point to mention, which just jumping forward to the last point really, is that the ability to claim BADR on disposal is obviously a key thing for EMI, and you don't have to have had the minimum shareholding requirement for EMI shares. As long as you've had those shares for 2 years and provided some of the other conditions on that, the shareholders should qualify for business asset disposal relief, which is obviously quite an attractive option for them. Gross shares, again, I think most people are common now with what a gross, most people are familiar, with what a gross share is, but broadly allows people to participate in the capital growth above a certain hurdle, so not the current equity value. So, a business is worth 2 million now, we award shares, as at whatever date we're on, day 7th of December. If that business grows in value from 2 million to 5 million, that 3 million of growth will be available to the individuals who have taken gross shares, subject to who gets what. The shares are often awarded immediately, therefore. So when I say immediately, I mean at the point at which you decide that you want someone to participate in the growth, you would award those shares then. You would have a valuation as to what that value of that company was at that date. Now, the upside of that is that they often have no or limited value at the point at which they're awarded. So this means that the tax consequences of the grant of those shares, or the issue of those shares is limited. There's also, unlike EMI, no restriction on the amount of shares that can be awarded in terms of, although at the point at which they're awarded, they have little or no value. Ultimately, those shares could be worth 4 or 5 million in 10 years from now. So there is no restriction on that. I just wanted to add one point in here, which was that although we've said here that shares, when they're awarded immediately, because say if you think about at day one, they have no value or limited value, then arguably that is where most of the valuations place the value of those gross shares at nil or limited value. Recently, there was, the HMRC Shares and Assets Forum, which is a group of people. There are lots of forums within HMRC. There's one for R&D, there's one for share valuations and shares and assets. They are, what that is a group of individuals who get together, who are interested in this subject and who talk about sort of pressing issues. And so there are a number of people from HMRC on that forum. There are also industry professionals who regularly work in that sector. So on this particular forum, there are a number of people that regularly work on valuations from the tax industry. And in September 23, they had a big debate about valuation of gross shares. And the upshot of that debate was that they said that we can no longer argue that the shares are worthless. And the phrase that they used was a serious attempt at valuation is needed. Now, they didn't really go any further than that. So there's a consensus that needs to be reached on what is a fair method for valuing gross shares. So I would just say there that we need to watch this space because, say most people have gone forward on the basis that at the point of issue, they have no or limited value, whereas there seems to be a slight change afoot there. A few things to consider, and then I'll remember to mention my example of my chap that runs a training business. So valuation, we've just talked about valuation in the context of gross shares, but also to mention that for EMI shares, you can and should request for that valuation to be approved by HMRC. but HMRC are no longer approving valuations for gross shares. So it used to be the case that you could write to HMRC and ask them to approve the valuation that you come up with for gross shares, but they are simply not doing that anymore. So one point I've made here is that we need to be, where you want certainty over the valuation, then an EMI might be a better option for you, or an EMI combined with gross shares, because you can't get that certainty, especially with regards to what I've just talked about with the forum about the valuation for gross shares. And the EMI, obviously, you may be aware that from EMI advanced assurance is required. So say you're already writing to HMRC potentially for valuation, but you also have to get advanced assurance or sort of clearance essentially to go forward with the EMI, so that the HMRC can verify that you or the company satisfy the conditions for that EMI scheme. Performance criteria generally going to be critical to commercial decision. I mean, this is for both EMI and gross shares, so you can put in place performance criteria. Again, this is a commercial point more than a tax point, but can affect the tax analysis. So the example that I keep coming back to in my chat with the training company, we've had some discussions with him about what kind of hurdles and performance criteria he wants to build into his share incentivization for the individuals that he wants to incentivize. Dreaded employment-related securities issues. I say that because it's something that a lot of people, when they say employment-related securities, I remember when I used to practice as a tax lawyer, I used to think, oh God, employment-related securities, you know, and there's some quite sort of detailed, lengthy legislation around this. It's not as scary as it might look, but nevertheless, you have to get things right. So making sure that you are reporting what you need to report, particularly around things like Section 431 elections, so making sure that at the point of those shares being granted, that if needed, a Section 431 election is put in place, so as to ensure that you are only taxing what you need to tax. And again, I'm talking in sort of really colloquial language here. It's a lot more complex than that in technical terms. But having Section 431 elections in place on day one is often crucial to the tax analysis at the point of disposal. So making sure paperwork is robust and decisions well documented as well, I put there. So, you know, making sure that the reasons for your decisions around performance criteria are documented, and that the scheme has some, you know, robust paperwork in place, which again, lawyers would be able to help with that. And we work closely with lawyers to assist clients with putting in place some wording around the scheme that they want to offer. So I mentioned, and again, I'll just, before I go on to the next slide, I mentioned an example of a chap we've been working with recently who runs his own training business. So he has been running that for about 10 years. He's had some good success with that business and has now got to the point where he scaled the business to some extent, but needed to bring in a managing director. So as part of that managing director's package, he wanted to offer share awards to that managing director and to incentivize him to help the chap grow the company over the next 10 years, heading towards an exit potentially. And what we did with him is we looked at a combination of EMI and gross shares for him. Now, one of the first barriers we had with him was that his trading business was owned by a holding company. The holding company was not a trading business itself. And so I think if I flip back to this slide, and we're talking about trading company or parent of a trading group, one of the things we had to do with him to start with in order to ensure that the trading company qualified for EMI was to do a little demerger exercise, so to separate the trading company from the holding company, such that the trading company would qualify for EMI. And we've got that all in place for him. And now we are at the process of putting in place the gross shares combined with some EMI share options for the managing director. Mm-hmm. Next hot topic then, going forward, post-COVID comings and goings, I've referred to it here. I mean, again, none of this is sort of rocket science. I'm not trying to teach you anything particularly today. I'm just, you know, as I say, keep saying, trying to tell you about some of the things we are genuinely seeing day in, day out at ETC at the moment. So I've said here, and I suppose this applies not just to individuals, but to their businesses. I'll maybe touch on that in a minute. But this slide primarily focuses on individuals going overseas. So as the UK is becoming increasingly highly taxed, unfortunately, people are looking for alternative options overseas. And obviously, we've also had years of restricted movement during the COVID pandemic. So we have genuinely seen a surge in people relocating both to and from the UK. And what you're looking at here on an individual level is residence and domicile, really. And that's something we have a lot of expertise at ETC Tax. So things to consider, again, just things to flag, really. I mean, we're all kind of used to, I guess, people, say, coming and going, moving abroad. And the first thing to think about is whether that is a permanent or a temporary move. And that has a bearing on the tax analysis very often. You may then come across something called a split tax year. So I'm going to use the example of my husband. Some of you on this webinar may know that he has moved to Dubai. He recently has moved to Dubai, and he moved in September of this year. So this period from September 2023 through to April 2024 will be what's called split year for tax purposes. And essentially there is some work to be done, and indeed some work has been done in calculating and working out how he will be taxed in this split year and how many days he can spend in the UK, or midnights, I should say, during that split year, in order to ensure that the period in which he's abroad now does not become taxable in the UK. So there's, some analysis, but also some planning if you want to, or if clients want to ensure that they are taking themselves out of the UK tax net in that split year for at least the period in which they're abroad. So that is something to consider. We've also got short-term business visitors. So again, these are sort of concepts which you may or may not be familiar with. So short-term business visitors, where employees of companies, and again, I'm just referring to some notes here because I need to make sure I get this right, where they're required to travel abroad on business regularly. This can sometimes result, and it's regular, again, there's lots of conditions. When I talk about regular, it's obviously defined in law what that means. But where they're required to travel abroad regularly with work, that can sometimes lead to double taxation of employees' earnings in the countries that they are visiting, and also the countries in which they are sort of residing, essentially. So obviously there is a consideration there. Nobody wants to be facing a double tax charge. So in the UK, we have an administrative relaxation for short-term business visitors. So normally that applies to people arriving from overseas, working in subsidiaries of an overseas company, but within the UK. So they can, those UK subsidiaries can apply to relax their obligations regards PAYE and how they tax that employee's earnings if those employees are considered short-term business visitors. So it's something to think about there. Tax equalisation, on the other hand, I put here primarily relevant for those leaving the UK. So this is all about when companies are sending their members of staff abroad to work. Let's say someone's being sent to, I was going to say US, but US is very complex for tax. So maybe we'll leave the US, let's just say Finland or something. And if those employees are going to work in Finland, and if they would be worse off from a net point of view as a result of going abroad, so let's say Finland has a higher taxing regime than the UK, and the individuals will be worse off, we can work with companies and individuals to put in place tax equalisation policies, which basically means that those individuals, when they go and work abroad, will be no worse off than they would have been had they been in the UK under, let's say, a lower taxing basis. So that's what tax equalisation is all about. And we've done a number of those with clients who are with accountants and lawyers who have clients who are sending individuals to work abroad. Domicile, I've just put a mention of this at the end. Again, I'm sure you're familiar with the concept of domicile, many of you, obviously very different to residence. And whilst it isn't just about long term, tends to be more relevant when people have gone abroad, emigrated essentially, or moved abroad indefinitely. But obviously always worth looking at domicile, indeed domicile positions where people are spending significant periods of time outside the UK or plan to. Next hot topic then, so let's take a little sip of drink a minute. We are, fortunately or unfortunately, fortunately I suppose for us because it keeps us busy, but unfortunately for taxpayers, finding that there is generally a trend towards more and more inquiries from HMRC, I suppose. So I put here HMRC have their fingers in lots of pies. I think that's fair to say. I'm sure many of you will be aware that nudge letters, one-to-many letters, as they're often also referred to, have been on the increase, but also we are seeing many more inquiries, compliance checks, and even discovery assessments. And I think this is just part of a general trend. I don't think it's necessarily the case that people have got worse at paying their tax. I think it's just that HMRC are a little bit more alive to this and have been for a number of years, and so there are more and more now clients receiving letters from HMRC. Sadly, the dreaded brown envelope lands on the doorstep. So I think a few points to mention there, and again, I'll give a specific example of one we've seen recently regards nudge letter. There is nowhere to hide, I've said, and that sounds a bit depressing, but I think the point there is that, as you may be aware, HMRC now have much wider powers to share data with third parties, so third parties like Companies House. So there is this general information sharing process going on behind the scenes, much more widely than it ever used to. Obviously, we've seen it with crypto tax, but say generally with Companies House, there is now, slightly separately, but there's now a requirement for us in the tax industry, indeed in the accountancy profession, to report to Companies House if we notice differences in the PSC, the Persons of Significant Control Register, compared with what our clients are telling us, for example. So if we've got clients saying, well, our company is 50-50 owned, but actually when we're looking on Companies House, we note that the PSC register suggests something different, suggests that, say, 75-25, then we need to flag that potentially to Companies House. We are allowed to talk to our clients about that beforehand, but we do need to flag that to Companies House if nothing is done to remedy that position. So the point is there's a lot more joined upness, I think, with a lot of the these organisations. And so, you know, you say there really is nowhere to hide, not that we'd want the clients to be hiding anyway. And we've seen, certainly with nudge letters, really wide-ranging campaigns, ranging from nudge letters targeting online traders and influencers to business asset disposal relief to property income and gains, and also most recently to property incorporations specifically related to the 2017-18 tax year, which I will come back to in a minute. And what I would say is, generally speaking, you've just got to ensure that clients are treading carefully with this. So we do want clients to be acting quickly to potentially mitigate penalties, but we do want clients to be aware of giving away too much information. I've put here strategy is key, and it really is, because you never want to give away more than you need to, I would say. And that's not in any attempt to hide anything, but you don't want to be giving away too much information, because then you are essentially giving HMRC carte blanche to delve a little deeper, and that could cause more problems for clients than you know that they started with in the first place. Oh, sorry. So let me come back to my example. So the most recent nudge letter, again, just to give you a light example of the way that HMRC seem to be approaching this as well, and they are a bit sneaky. So they've recently sent out a nudge letter to those that incorporated their property businesses in the 2017-18 tax year. We haven't had any clients approach us about this specifically yet, but we are aware that there are letters out there. And the reason for the letter is because they are suggesting that people may have claimed incorporation relief in excess of what they were able to do so, basically. So where the gain arising on incorporation exceeded the equity value of the business, that the individuals have sought to claim incorporation relief for the entire gain, whereas that may not have been possible. So that's the crux of the letter. The point that I really wanted to make, though, was that they have, in that letter, said that you've got 30 days to tell them if you think you might have an issue, which, you know, is fair, I suppose. But the other thing they've said in that letter is, two other things they've said in that letter is, even if you think you've done it right, we invite you to tell us you've done it right and to disclose your figures to us. Now, I think that's a bit naughty, and I would strongly be suggesting that clients think very carefully about going back to HMRC to tell them they've done it right, because if they've done it right, they've done it right. There would be no reason, theoretically, for them to need to go back to HMRC. But the way that the letters are worded is a bit open, I suppose, because they also then go on to say that if there is no response within 30 days, and they're a bit vague as to whether that's in the negative or the positive, that they may decide to issue a discovery assessment. And again, for those of you that know what a discovery assessment is, generally HMRC have 4 years from the end of the tax year in which the mistake took place to issue discovery assessments. So we are 17-18 with this letter. So in theory, they have until April 22, 5th of April 22, for a discovery assessment. So we're out of time. They can go as far as 6 years if they believe there's been some carelessness here. So we assume that that is what they'd be relying on in raising the discovery assessment, this idea that there's been carelessness as opposed to just the bog standard 4 years. But as I say, they just are the letters that I'm seeing, the nudges that I'm seeing are getting more and more, sneaky, I would say. I can't think of a better word for that at the moment today, but sneaky in their approach to try and get information out of people. Right, moving on then. I don't know what point we're on here, but another hot topic, accidental landlords. It's not a hot topic in the sense that we have had clients talking to us probably since 2015 about their property portfolios, and lots of changes, as you're probably aware, occurred from about 2015 onwards, which has made landlords feel a bit aggrieved in tax terms. The problem that we're now seeing primarily with landlords, out with all the stuff that's gone on between 2015 and 2023, is that a lot of them are waking up to the fact that they're going to face a significant IHT liability, potentially on death, because some of these portfolios are quite substantial and with quite some value. So we know now, don't we, there has been no IHT changes as anticipated. There might have been in the recent autumn statement. And the other thing that I would say, and I really can't emphasize it enough, is there is no IHT magic wand. Day in, day out, we have clients coming to us expecting us to wave away their entire IHT liability. And unfortunately, it's just not possible. Well, it is possible, but you have to start early. And that's my next point, really. Start early and never too early, really. So by starting early, clients have the opportunity then to reset the 7-year clock for IHT purposes. Otherwise, when you've got clients coming in their 60s, 70s, and even 80s sometime, there is a real limit to what we can do to assist them. So I put some general points here. And again, these aren't anything that's supposed to blow your mind. This is just general points of interest around IHT and related to landlords, but could also be related to other assets and the estate in general. So obviously landlords can consider gifting properties, but then of course they're giving up control. They've also got to watch out for the gifts reservation of benefit rules, meaning that if they are gifting those properties, they can't then continue to take income from those, let's say, buy-to-let properties, because they have essentially given those away. So that's fine as long as they don't need the income and they don't mind giving up control of the asset. That's pretty extreme, I guess. We can look at gross shares, particularly where those properties are held in a company structure. Obviously, when we've already got that company structure in place, and a bit like I talked about with the family investment company earlier, in fact, exactly like that, we can think about different classes of shares and gross shares potentially for family members. But as we know, those don't protect the current value of the estate. So great if we're anticipating there's still going to be quite a lot of growth in property values, or if over time, as you might expect, any mortgage debt is going to be paid down such that the overall value of the business will increase, but don't protect that current value. Trusts still have their place, and again, thinking about putting current value, so thinking about protecting the current value of those assets up to the nil rate band of 325, obviously 650 if you've got jointly owned property, and then think about repeating that every 7 years. And that's why, again, starting early can have some huge benefits. Or potentially gifting shares in the property company to a trust and holding over that gains, which is another option for doing that. But again, you've still got this 7-year clock running. The other thing to mention, but unfortunately only relevant for commercial property, is considering use of pension funds. So we know that the lifetime allowance has now been abolished from April 2024. So there is even more opportunity potentially to put some quite significant sums of money related to commercial property into pension funds, which would obviously take those funds out of the IHT wrapper, at the IHT, the estate essentially. So I think this is actually the last one. How are we doing for time? Yeah, we're okay for time, and we've got time for some questions at the end. So I think I've just put on here VAT, the forgotten tax. I think I've put here also a point of interest, which I'm sure some of you probably aren't aware of, but on 1st of April 23, VAT celebrated 50 years. Happy birthday to VAT, 50 years of that in the UK. I think the problem here is there's just simply not enough understanding of the detail beyond VAT returns. And we talked earlier about the fact that we are seeing more inquiries generally from HMRC, but we have got a significant number of VAT inquiries and disputes that we are dealing with at the moment. And I'll again talk about some examples of those in a minute. But really generally lots of VAT queries coming through from clients in general, which is great to get those queries in at the point at which something is being thought about. But unfortunately, lots of disputes or VAT issues with HMRC that we're dealing with as well. I've put on here some specific challenges related to VAT, and again, this is just to flag some specific sort of, I suppose, higher risk areas really. So online trading, financial services, and land and property. There are other areas, lots of areas in VAT. I don't know, again, if you've heard recently about, we used to have years ago the Jaffa cake debate. Now we've had the sort of club biscuit debate in terms of whether that is vatable or not, and lots of, we had a client the other day talking about yogurt and how yogurt might be treated for that purposes. So there's some real sort of strange quirks of the VAT legislation that you wouldn't necessarily think about day to day. But I think these three areas are the areas that we come across most often with clients. So I've just flagged here some points really. Generally speaking, I'm sure this is the case for you and for your clients. There are more and more people now who are trading online. Obviously, the world has opened up. There's lots of opportunities to have Amazon, eBay accounts, you know, all sorts of Vinted, you know, all these kind of online selling accounts. And clearly, there is a distinction between those that are just doing this for a hobby and those that are doing this on a more commercial basis. Nevertheless, for VAT purposes, the distinction is not as great as it might be for some other taxes. And I think that the position is now more complicated that now that the UK, and obviously we've been separated for some time from the EU, but particularly for VAT purposes. So things that clients that are trading online need to think about are the rate of VAT that they're applying, the place of supply, and the timing and value of transactions. So whilst in a lot of cases, not all, with online trading, the place of supply may be where your customer is. So let's say someone is in the UK but selling to lots of people in France, such that those supplies may be outside the scope of UK VAT, those individuals may be required to register VAT in those other EU countries. And we have, although we are primarily UK tax specialists, we can assist and advise on when that liability might arise in relation to those other EU countries, and we can bring in overseas specialists if we need to assist with the VAT in other countries. But again, just to be aware that it's not just a case of thinking about UK position, it's thinking about what other countries those individuals might be selling to. The other thing that we've seen which provides added complexity is that it's often common, and as in any business I suppose, but to offer promotional discounts and vouchers for online trading, which can again bring added complexity to the VAT position. Financial services, again, often VAT exempt, I've put here. So financial services generally often exempt from VAT, which means that the individuals that are running financial services businesses can't recover the VAT they incur on their own supplies to the business. So let's say they're buying some stationery that has VAT on it. If they are running a financial services VAT exempt business, they won't be able to recover the VAT that they've incurred on that stationery cost. The thing that we need to remember with financial services is it can often also apply to brokers and intermediaries of financial services. And I think the critical thing here, and this is really one that gets overlooked very often, is that it can also apply where even the core business is not a financial business. So let's say you've got a retail business that also provides credit or finance for purchase of its you know, its goods that it sells. That can be an exempt supply for that purpose, and that can bring some tricky issues around the fact that the core business might be VATable, but they may also then be making some exempt supplies of finance, which can then throw us into something called partial exemption for that purposes. And so again, that gets a bit tricky at times. And then the favourite, I suppose, for that, which I think a lot of people are very well aware that with land and property, you do need to think about VAT. And I think I've just put some trigger points here, really. This is saying not intended to be technical, just intended to be trigger points so that if you have clients with these kind of situations, you can sort of think, oh, there might be an issue here. Firstly, we've talked a lot about landlords already today. We often see landlords, buy-to-let portfolios, but we kind of neglect developers a little bit sometimes. And developers and VAT, some interesting things going on with developers with VAT. And we actually say to developers, and it's true really, I think, to be fair, it's not often that you have any two projects that are the same. So even where we've got seasoned developers, it's always good, I think, to just double check that when they are about to commence that development or thinking about a development or even thinking about purchasing a development site, that they are thinking about what the VAT position on that site might be. As you know, really there's some really kind of key reliefs that they may miss out on if they're not looking at the VAT position and or not be able to maximise their VAT recovery in relation to the development costs. The other things to think about, and again, these are general, I'm not saying that in every situation where you've got this going on that there will be a VAT problem, but I think residential property, prima facie, that's exempt from VAT. There are some particular situations. So, for example, new builds, would be zero rated for VAT purposes, which is distinct from exempt. But where you've got commercial property, where you've got residential conversions or renovations, where you've got new builds, which I've mentioned, or where you've got charities or things like property being let to housing associations, then really I would say always seek the advice of that expert. When I was, again, practicing as a lawyer, actually, and we've obviously seen it in practice here as well, those are the kinds of things that we would, in our team, regularly advise our property colleagues on. When they saw one of these things going on, they would come to us and say, is there anything I need to be thinking about in the context of this particular client? So I would say those are the things that really you need to be aware of. And then really just to finish up with, and I'm just going to again refer to notes here for some of the case studies that we're working on, just to make sure I give you the full list. I mentioned earlier that unfortunately a lot of these VAT issues are ending up in disputes and inquiries from HMRC at the moment. And I think, again, just to give you some example of 3 or 4 cases we've got on at the moment, so we are currently dealing with a dispute over the application of a surcharge liability notice in relation to late file VAT returns, where that's built up over a number of VAT quarters and actually has ended up in a substantial, I think, £400,000 debt to HMRC, and whether there's anything we can do to mitigate that liability and ultimately to defend that position. We are dealing with something called PVA, postponed VAT accounting, for a client where they have been importing goods for use in their business. And again, I think that has resulted in, again, throwing these numbers out there, but they are, quite big numbers. I think, again, that's about £700,000 of VAT at stake in relation to the PVA scheme. And that's something we're dealing with for a client at the moment. We have an online trader whose Amazon account here. So, and this is a trader who, this is his business, and he puts, I think his turnover last year was about 3 million or something, who uses Amazon for most of his sales, but his account has recently been frozen due to an argument whether he was VAT registered in the countries and in the UK in the way that he needed to be. So, and we're interested on this because we're just trying to get to grips with Amazon and what Amazon are doing with things like this. So, obviously they are taking responsibility for their traders, but basically they've frozen his account pending proof of that registration. So we're just trying to sort that out between Amazon and HMRC at the moment for a client. And then the other one, which is again land and property related, is a dispute over an option to tax, in terms of whether an option to tax existed over land and therefore whether that should have been charged. And I think there's one point to make on that, is that from, I think it was February of this year, HMRC stopped confirming whether options to tax were in place. So it used to be the case that if you weren't sure whether there was an option to tax in place over a particular piece of land, you could write to HMRC and ask them to confirm. From February, they've basically stopped doing that, except in very limited circumstances. And I think it has to be a minimum of 6 years ago and things like that. So really now clients need to be keeping their own records. They also no longer, when you notify an option to tax to HMRC, which you have to do, and that's what the law tells us we have to do, they no longer confirm that back to you. Essentially get an automated response. So clients need to be keeping records, really, and I think records for all of these things are key anyway, but just making sure they've got records of those options to tax and that they've got those readily available if needed. So I think that probably brings us to the end. And again, where are we? Yeah, we're about 10 minutes, 10, 15 minutes before the end. So just then, before we close, just to mention our next event, which is again an online webinar, and that is taking place on Thursday, the 22nd of February at 10 o'clock, and that is Traps to Avoid on Corporate Restructures. And that's a joint webinar actually with Bermans, who have kindly agreed to join us for this one, and thinking about both tax and legal aspects of things to watch out for on corporate restructures. I think that is it. So we will open to questions. I'm hoping Sarah will jump back on now and take any questions we've got from any of you. And if you want to email them in afterwards, please do. My email address is there, and our general inquiries email address is also there if you've got any questions afterwards that you want to send separately.
Yep, hi, no questions have come in, but please do feel free to drop us an email, either in inquiries or at comms@ettttax.co.uk, and we'll be happy to answer anything. I will be sending the recording and the slides over to you within the next week. Thank you, everybody.
Okay, yeah, we'll just see if anyone's, I'm assuming nobody could say, nobody's questions come in. I don't know if anybody can speak, can they, Sarah, or is it through the Q&A?
Yeah, it's all done through the Q&A.
Okay, fine. Okay, that's great then.
Thank you.
Thank you, everybody. Have a good Christmas. Thank you. Thanks.